Hey everybody, welcome to this free edition of our Trader Use Group Weekly Roundup for the trading weekend in September 29th, 2023. I'm Preston Brent. Thanks for tuning in. Well, this week's theme is, like many other statistically relevant prior years, September lives up to its reputation with a little bit of a pullback. So remember, guys, you want to be the rat brain trader. You do not want to be the rat brain trader. You want to be the red striped zebra. So we want to trade smart in these kind of environments. So let's take a look at how we finished up this past week. You can see here it's a little bit mixed. We had green both in Nasdaq and Russell, just barely in the green. Year to date, both hanging in there, along with the S&P and the Dow in the red for the week. But year to date, everybody's in the green, but just barely with the Dow and the Russell. The S&P gave up a lot of its gains. In fact, if we look, this is the fourth consecutive weekly pullback for the S&P. Down September, a little over 5.35%. For the third quarter, the S&P is down 3.65%. So we're seeing some of that weakness that I mentioned earlier, where we get that statistical relevant pullback in September. And I'm seeing a little bit more risk until we get through October into November. We may get a little bit of a bounce, but then I see a little bit more of a weakness coming in the middle months of October through the end. Now, we've got earnings that are going to kick off in about 2 weeks. So perhaps if we get strong earnings, which is what the markets are forecasting, are better than expected earnings, then we could see the markets give us that bounce. But we're going to see soon enough. Okay. You can see the PE ratio is still a rather expensive 19.43. I'd like to see it come down another couple of points given the high interest rates that we're currently facing, but we'll see. Dividend yield with the S&P is at 1.62, 10-year Treasury, which is what caused a lot of agita for the markets over the past 4 weeks. We've seen the yield on the benchmark 10-year. It actually peaked over 4.6, then pull back a little bit, but still over 4.5. So that's adding to a lot of downside pressure on the markets right now. The earnings yield is at a strong 5.1%. Dividend yield or the S&P yield over the S&P Treasuries, almost flat, 53 basis points. But the real yield is at 1.90%. So that's rather healthy because inflation has come down a pretty good bit since the peaks of last year when it was over 9%. Current VIX, well, it is up just a little bit for the week, 1.87% higher from the prior week's close. So we're staying in that 17, 18 zone, but it hadn't gone crazy, and we're still in a normal term structure skew in a contango. So I don't see any fear in the term structure of volatility at this time. Okay. Now, we did get the PCE. I talked about inflation. PCE came in August, and it increased it was at 3.9% year over year. That's the lowest annual inflation rate we've seen in 2 years on the PCE. That's the personal consumption expenditures. That's a very closely watched gauge by the Feds, by the way. That's one of their primary gauges that they follow. So that kind of helped the markets initially, but then from that big move open, we closed back lower. So that's a bearish candle that we had as we closed out the month of September. But this is the lowest annual inflation rate in about 2 years, right? Target for the Feds is 2%. So that's a little bit about what we're seeing there on the PCE. If we come over and look at the best and worst performers weekly and annually, you can see for the week, energy strong, utilities got crushed. 6.21%, really just an ugly week for utilities. And you can see year to date, very ugly for utilities. And that is what happens when you get higher interest rates, because utilities is such a capital intensive business to run a utility. When rates go up, it's like a bond proxy. These things go down very hard, right? And very similar to what you see in the bond market. Okay. So just not a very pretty time. And then, of course, if we come over to Europe, you're going to see over here, everybody was in the red for the week. Not by a lot. You can see the Euro stocks, the 50 largest companies across Europe, 80 basis points lower. The FTSE CAC 40 all just less than 1% lower for the week. DAX down about 1.1%. Year to date, everybody's in the green. The FTSE's just barely in the green by 2.1%, but still everybody's in the green. And then, of course, if we look at this, the ECB officials came out this past week to reaffirm their restrictive monetary policy. Okay, their goal is like the Fed's here in the U.S. They want to bring inflation back to 2%. And their consumer prices right now are at 4.3% annually. So it's weaker than forecast. It's the slowest pace we've seen in Europe, like here in the U.S. for a couple of years. Now they were at 5.2 in August. So it's coming down nicely, but they're still reaffirming their stance, much like the Fed's here, right? And we see over in the UK, their economy grew a little bit faster than expected in the first 3 months of the year. As revised figures, we're getting these out of the UK now. Their first quarter came in at 30 basis points. The previous estimate was 10 basis points. Okay. The second quarter was unchanged. So while it's growth, it's almost flat, right? I mean, that's what we're seeing there. And then, of course, if we look at Japan, look at the Nikkei. It was down in the red just a little bit for this week. Year to date, it is just trailing NASDAQ as one of the best major country performers in the index, right? 22.10%. So the yen, which is what we're following very closely, traded, around the 148 range against US dollar. And it did weaken intra-week to 149. It was an 11-month low. But and all the market participants are watching to see if the Bank of Japan is going to intervene. They haven't yet, but believe me, and members, we'll go through this Sunday evening, but I'm just, we got a trade in there for the yen for sure. And it's going to last a while for us. Meanwhile, the yield on the 10-year Japanese government bond, the JGB, was up to 76 basis points. All right, that's the highest it's been in over a decade. And the Bank of Japan went out in the open market and bought about 300 billion yen to try and step in and prop it up. Our government bond, they bought about 300 billion in government bond, but that really didn't do much, right? So I think they're going to get more aggressive here shortly, and that'll be good for the yen, right? But right now, it's kind of at a low point that we haven't seen in quite some time. Meanwhile, if we look at the Chinese markets, you can see both China and Hang Seng are down, all right, for the week. Year to date, China is at 69 basis points, so it's essentially flat for the entire year. Hang Seng's down just slightly under correction territory at 9.91%. Okay. China is going on a 10-day holiday starting Friday. I wish we had 10 days off for the markets, but I'd hate that see that opening gap when the markets finally open. But they're not going to open until October 9th. Not going to get any official economic indicators were released this past week. Very limited information coming out of China, for the week. So they did release some August data that showed that they're showing signs of stabilization in their economy, which I would expect because they've just fallen hard all year. I mean, it's essentially flat, right? And that's not normal for China. So, but they're just having their issues. And I think it's going to continue into next year. Any rally could more than likely be sold off. What I want to do is take you over to the E-mini S&P 500 futures. I'm going to just quickly run through some of the major indexes here just to give you guys an idea. Members, we'll go through it in a little bit more detail Sunday evening for our weekly market watch, but it takes a couple of seconds for this to come up on the screen. Now what you see is the E-mini S&P 500 futures. As I told our members weeks ago, all right, we had that pattern setting up, and sure enough, it triggered. If I were to draw this right like that, I'm just going to draw that pattern. That's the left shoulder, that's the head, that's the right shoulder. And I've been talking about it now going all the way back to early September, right? That's the left shoulder, that's the head, That's the right shoulder, a head and shoulders pattern. I said if we do break, we'll probably find a little bit of support in this area, which we did, which is sitting right on top of the 200 EMA. Okay. I said if we do this, expect a retest, and that's exactly what we did. As soon as we hit that retest, we gave it all back up on Friday. All right. So now the question is where to from here? All right. I mean, where are we going to go? And a lot of it is going to depend on basically what we're going to see from earnings. Remember, the Feds don't meet in October. They have an official, let me take that back. They have an official one-day meeting on Tuesday, the last day of October. And then the first day of November, November 1st, they come out with their prognostication. But with the inflation, the PCE coming in a little bit more than expected this past Friday, the odds of a rate hike in November came down just a little bit, but they're staying higher in December. So a lot of participants believe that they're going to hike the rates another 25 basis points before the end of this year and then stand pat and keep rates higher for longer next year. All right, and that's what's got the markets upset right now. So where are we going to go from here in the markets? Well, it's going to be real interesting. I think the 200 EMA, as you can see, I want to see us stay closed above the 200 EMA. We may challenge that again. There is a support level that runs slightly below the 200 EMA in this shaded zone, which is off the screen, but it's a big support area for the SPX, anywhere from about 42.75 down to right around 42.30. And then we got a 42.17 key fib node right below that. Okay. Notice this is an Elliott wave 3. Coming down, and typically with an Elliott wave through, we have a move up for 4 and then a final capitulation for 5. Now that's kind of what I'm seeing for the month of October. So we're in that counter cyclical move right now in the first week or two in October, and then a capitulation move giving us an Elliott wave 5 a little bit lower, and then we have a run through the end of the year. Now that's what the charts are showing. Notice here there is no divergence. In fact, this MACD formation down below suggests that any move higher is only going to roll back over again. Okay. So that's the expected move, guys. So you need to be careful with it. You can see since the highs here that were made on July 27th for the year, we were up 19.99% in the futures. And right now, if I were to just kind of benchmark it, do a quick benchmark on the futures price now, we are down right around 6.83, call it 6.9% roughly, right? A correction in the futures market would take us all the way down to around 41.50 area, right? Right around that area right down there. And when we get down in these areas, technical patterns play a big role, all right? And that's where algos and buyers tend to step in or sell, or where they set their buy stops or sell stops, right? So we're going to see some action around that. This week, I would expect the 200 EMA to be challenged, possibly break, possibly run down a little bit lower, but we are in our counter-cyclical move with this Elliott wave 3. That was a very bearish pattern on Friday. Typically, Mondays tend to carry through the momentum that we saw on Friday. Now, we were down a pretty good little bit, then we kind of made a mad dash back up towards the end. But the odds do favor a little bit of a counter-cyclical move higher and then a rollover in another week or two. And that would be timed perfectly with earnings coming out. And remember, we got a government shutdown that's probably going to take effect midnight on Sunday, which means come Monday opening, the governments will be officially shut down. Now, price action may not react too negatively to that because so far, every time we've shut down about a half a dozen times in the past couple of decades, that it always unwinds itself within 2 or 3 weeks. So the market's going to expect that. If it starts to extend more than 2 or 3 weeks, then you're going to see the markets act unfavorably. Okay, leading up to the next Fed meeting on November 1st when we get the next interest rate decision. So that's a little bit about what I'm seeing in the major index, the S&P, right? Members, we'll go through in more detail NASDAQ, the Russell, and the Dow. And then, of course, if we just come down here and take a look at volatility, right, and we see where VIX is, as you can see, it closed the week at 17.52. We kind of ran into resistance right at that level right up here, right around the mid 18 level. I expect, and I was telling our members, expect to move up into this resistance level, which is about 19 and a half. Okay. When we were down here, back in this area over here, I was telling our members to pick up puts or do bull call spreads in the VIX. And there are a number of different ways you could play the VIX. Just understand how the VIX works and how it's measured against volatility futures in future dated months if you're going to trade options on the VIX. We have a couple of more creative ways of doing it and playing volatility. But right here, just a real simple play for most folks is just to pick up out of the money puts, right? And then we move higher. You could see this move up here. We're going to stay elevated until we get through. I think it's going to be like this and choppy until we get through earnings. We need to see where earnings are coming in. Remember, everybody expects earnings to be better for Q3. It's a law of mathematics where you're comparing Q3 of this year to Q3 of last year. So we got a low hurdle bar to hit. So we should see some improvement. But where all the market participants are going to be watching is forward earnings. Everybody wants to see how the impact of these higher rates for longer are going to impact corporations and what they're doing for their adjustments. So we're going to see how that plays out through the month of October into early November. So this is going to be really key. That coupled with the government shutdown, higher oil prices, and I haven't even talked about the UAW strike and how long that's going to run on. So there's plenty of activities out there that can really move the markets much lower than where it is right here. Just looking at the charts alone, it's suggesting a lower price. So it's still a time to be very careful and hedge your bets a little bit. Okay. If we come in here and look at U.S. Treasuries and we look at the bond market, you can see the bond market. I've got to adjust it here, but we're at new 2023 lows, right? That were really made back on September 28th as we move lower. And that means I've got to adjust interest rates, but you can see the spread between the 50 and the 200 EMA of the bond market as it moves lower, right? And now my target for bonds this year is down about 107 and a couple of ticks. So that would suggest another 6 or 7 point move lower, which would suggest the Feds are going to stay hotter for longer. This is where the chart is leading me right now. And if we look at interest rates, right, and we look at the 10-year rate, you're going to see the 10-year rate. Again, I haven't adjusted it yet, but my chart is suggesting the 10-year rate is going to move all the way up to 5%. If it does that, and notice with the MACDs, there's no divergences. If we get the 10-year at 5%, then you can bet 75%, 80% probability equities are going to be lower than where they are right now. Okay, especially the high flying Magnificent Seven, which comprise about 45, 50% of the Qs and about 25, 27% of the S&P. Okay, so we're going to see where all of this winds up, and this is going to dovetail into earnings because I guarantee you the CFOs and CEOs on the earnings calls are going to be asked the question of how higher rates are going to affect their go-forward projections, right? Some companies are more rate sensitive than others, and if they are rate sensitive, then the analysts are going to want to know how do they protect their profits. Otherwise, there's going to be margin reduction, and that's going to reduce valuations of companies if sales falter too. The other thing that's holding up the markets is consumer spending. And if consumer spending weakens, I think it's just you're going to see more downside action than upside. So we still have a lot of risk in front of us. Okay. And then statistically, once we get through the middle to end of August, we should see a rebound through the end of the year, and then we move into a whole new year. Okay. Currency-wise, the U.S. dollar was on a tear. You can see I've got to adjust this also well into the green. It's an Elliott wave 3. This means we've got a little bit of a pullback, one final move higher, and then that'll be it for the dollar. We're going to want to go long the dollar, I mean, short the dollar, just not right now up at this level. I think we still have some more moves. Okay. You can see that's a consolidation um, uh, pattern in MACD where it's not moving higher, but price action's moving higher. It's just choppy. It's consolidating even though it's moving higher. Remember, it's a dollar index. It's not the dollar. So the dollar index moves contra the euro, yen, pound, Canadian dollar, Swedish krona, and the Swiss franc. But the euro, the yen, and the pound account for about 90% of the value of the dollar index, right? The euro is almost 58% alone. So, and the euro is going to be a natural opposite mirror image of this, right? I mean, if we look at the euro, let me find it, pull it up on the screen. It's going to look just the opposite, right? Here's the euro. We're down at 2023 lows right now. The last time the euro was down this low was in January 6th of this year. We've broken through the 200, clearly the 50. We're going to have to retest these and get long again. But right now, again, MACD pattern showing consolidation down at that level. So while the dollar's consolidating higher, the euro's consolidating lower. And we're going to get a night. We've had two entry signals for the euro over the past 24 months, both of them very strong, very bullish, and we've done very well. Right now, as we get through all these interest rate gyrations, currency, which causes currency choppiness, we're just waiting we're bid our time until we get what we're looking for. And then, of course, the yen, the yen, it is hitting my target down at this level down here, right? You can see the MACD's moving higher, but again, a very choppy, consolidated pattern. So, members, I'll go through a yen play with you guys in our Sunday night session, okay? And then, of course, if we come down here and look at gold, I told you guys with gold, it's neutral to bearish. This was my target for gold right here. I've had it on the screen for quite some time. You know, we closed out at 1864. My target was 1846 in the middle here, right? So it looks like, and we've blown right through all of these levels here. I was not short gold. That was my target. If we blow through it, we'll test and possibly even move into the red for the year for gold, right? And if you're saying, well, gee, with all this inflation, why isn't gold a lot stronger? And I would basically counter and say with a very, very strong dollar, that tends to put a lot of downside pressure on gold, okay? When we get the dollar rolling over, the euro moving higher, the yen moving higher, rates kind of stabilizing and coming down, you'll see gold move back up. It'll be a nice, interesting trade, okay? But right now, no. And then, of course, if we look at copper, it goes where China goes. You can see here, we're now in a consolidation phase here. It's trying to get back into the regression channel here. All right, if I just zip out a little bit, you can see where copper is. My target for copper was down at the bottom down here. And we got to see where earnings shape up and where this drives copper. Because if we have a recession in Europe and then it's followed by one here, we'll get copper down at these levels down here for sure, right? Right now, it's kind of consolidating. Of course, if we look at energy and we look at oil first, my target for oil was just, in fact, it was hit intraday, right? Let me just blow it up. You can see oil came up to 94.98, and the middle of my range was 95.41. So I've got to adjust the high price bar for oil, but we did hit my target, right? We've been kind of bouncing around my target, but it was the mid 90s, right? 95, let's call it. I do believe that we're in this consolidation range here. There's some great trades to take with oil in this area, and none of them are directional. And you can see the cross in the 50 and the 200. And that cross tends to act as a beacon for another retest. Now, that doesn't mean it's going to retest next week, because you can see in the MACD there's no divergences. That would suggest any dip lowers. The initial response is going to be bought, but I think eventually this is going to roll over. So there'll be some good trades setting up in oil as well. Okay, and then of course nat gas. We're coming into the winter months here, our fall, which will turn into winter. You can see with nat gas, bull put spreads is what I've been on. And I've just given you guys here for the free blog viewers a freebie. Just doing bull call spreads is kind of what we've having our members do. You know, going all the way back to middle of April. We were doing some flies back over here, but it can get very choppy. But bull put spreads is just an easy, lazy man's way to make money on that gas as it's been moving off these lows here. Right, you could see that gap up right there as we switch contract months. Kind of in the center of the regression channel, it'll probably settle back down a little bit. But we're coming into the winter months where it tends to want to move higher, right? And that's kind of what the price action is suggesting here. And then, of course, if we look at, let me just find it on here, gasoline futures. You can see here with gasoline futures, unlike oil, gasoline futures is moving lower, which will be good for the pump, right? I think it's going to start to catch a little bit of wind here and get a counter-cyclical move. But that's a little bit about what I'm seeing here in the energy market. All right, everybody, that's a little bit about a fast update for this weekend. Members, I'll see you Sunday evening for a little bit more of a detailed view. We'll look at some stocks that could be pretty good in this wacky market as well. Have a great weekend, everybody. And members, I'll see you Sunday evening for our weekly market watch. Ciao, folks.